Hello, my name is Tamika, and I am a Community Development Officer with Carrollton Bank. I've been in finance for over a decade, and today we're going to talk a little bit about budgeting. We're going to talk about credit. We're going to talk a little bit about predatory lending. So follow along. If you all have any questions, please reach out. Just let me know, and we'll review those before leaving today. One of the most important aspects of budgeting and finance is kind of money management. You have to create a budget. A budget is similar to a blueprint of your finances. And it's very simple. There's 5 steps. You list all your income. That's all of the money that you have coming in. That could be paychecks, alimony, any child support, any kind of money that you have coming in. And then you list your expenses. These are your bills. These are Netflix, your car note. These are rent, all of your bills. And then you just balance those. You budget them out and you balance them, and you determine if I make more money than I spend, and I need to figure out where it's going, or if I am spending way more money than I make and I need to calm down a little bit. So with that, you kind of balance out and see where your situation is, and then you review, communicate, and adjust your plan to your lifestyle. Are there items that I should cut out of my budget? Are there ways that I can improve my budget that will allow me to save for more funds? What is it that I need to do to make sure that my budget is actually working for me? And then I work that system. And if my situation changes, my budget should change with that. So you follow those steps to make sure that you can create a reliable budget to help you save your funds. So one thing that we don't always pay attention is to the small expenses. It's hard to keep up with a budget if we are not tracking our expenses or tracking how much we spend on certain items. One thing that I see as a common thing amongst the classes I teach is Starbucks. Everybody loves a good Starbucks. But what happens is that they go and they spend money on Starbucks, and it becomes a habit that they have to keep up with every day. Starbucks is a little bit expensive. It's not the cheaper of the coffees, I'll promise you that. But if I have a drink, a special drink that I get from Starbucks, and it is really good, it is so good that I must have one every day, and this drink is $5. If I purchased that drink every single day for an entire year, I would have given Starbucks $1,825. The bigger picture is, wow, right? That's way too much to spend on coffee. The smaller picture is the $5 that I can afford $5 here. I can afford $5 there, but we don't pay attention to how often we are spending that $5 and how much money is going towards a certain habit. And it doesn't have to be Starbucks. It can be any other transaction that comes up around the same amount that you have to have every single day, that type of habit. And then for a lot of the guys and a lot of the women, they say, I don't have a $5 everyday transaction. But then I look down and they have their nails done. Or I look up and they have a really nice haircut. And let's say that's a $40 expense every 2 weeks. Well, if I did that throughout the whole year, every 2 weeks, if I kept up with that maintenance, and I'm not saying don't get your hair cut, and I'm not saying don't get your nails done, I just want you to realize how much it costs. A lot of people say, I can't save money. Oh, I never have anything left over to save money. But if you save money from these 2 activities, then you could save $1,040 a year. So for those who say, I can't save $1,000 in a year, you probably can. So I encourage you to make sure that you go over your budget, you review that plan with yourself, you look at the small expenses and see how they add up and how much they're costing you, and if you're okay with that cost. Another thing that I want you to make sure that you are including in your daily lifestyle with your finances, because your relationship with your finances is really important. That's what we're doing. We're building that relationship. We're improving that relationship so we can make better financial decisions and find ourselves in better situations. So a part of that is making sure that your goals are SMART. Your goals should be SMART. And that is an acronym. The acronym stands for specific. My goals should be specific. I should say I want to save this amount of money over this amount of time. It has to be measurable. For example, if I want to save $600 in 3 months, that means that I need to save $200 a month. That means if I'm paid biweekly, I should save $100 per pay period or every 2 weeks. I'm measuring out how I'm going to get to the end of that goal, how I'm going to fund that goal. It has to be attainable. I tell this to the high school students all the time. Don't say that you want to save $1 million in a year if you don't make $1 million in a year. It has to be attainable. It has to be something that you can reach. It does not have to be super hard. It doesn't have to be super easy, but we don't want to set ourselves up for failure, and we absolutely want to make sure that it's something that we can obtain. It has to be relevant. It's important to make sure that your goal is important to you, because what do we do with things that don't mean much to us? We set them to the side. So if you see that Sally is saving money for a car and you already have a car, don't save money for a car. Save money for something else that might be important to you. And you'll stick to it. And it has to be time oriented. You have to give yourself a deadline, a goal. This is the date that I'm working up towards. Otherwise, we'll just keep pushing it back and delaying it and saying we'll get to it when we have time. So SMART goals. A bigger part of my classes is that I always like to use my sisters as examples. They will kill me. So my younger sister, I'm that person in the family. I'm that finance person. When we get together for gatherings, they see me coming in, they're like, oh Lord, here she comes. Yes, here I come. So we were at Thanksgiving, and my younger sister, I asked her, I said, hey, have you been saving money? And of course, she gave me the look like, oh my gosh, here we go with this. And she says, no, I have not been saving money. But I'm going to tell you why she was honest. Because her bank account is at my job, I was just going, look. But I wanted to give her the opportunity to be honest up front. So I said, have you been saving money? She said, no, I have not been saving any money. But next year on Thanksgiving, I got you. There's going to be money, I promise. I said, okay, well, I'll leave her alone. You know, I'm not going to nag her. So the following year comes up, and she sees me, and I saw the dread pour over her body. And I say, hey, sis, you been saving money? And she says, wait, listen, hear me out. I only got about $9 saved. And I said, $9? So what we're realizing is that her goal wasn't SMART. She never said how much she wanted to save and by when. It wasn't very specific. It wasn't measurable. She didn't map out how to get to that goal and how to complete that goal. She didn't set an attainable goal. She didn't set a relevant goal. That goal was important to me, that she saved money, but it wasn't really important to her because she was just building a basic savings, not saving for a car, which she would have loved doing, or saving for something else. The only thing it was time oriented, and I gave her the deadline for that. So she did not complete a really good goal because she did not set a really good goal. So make sure that your goals are SMART. Make sure that you thoroughly plan them out. And those steps, those specific acronym areas will allow you to reach your goal and become a little bit more successful when making them. There are different types of goals. You have short-term goals. That's anything that takes less than a year to complete. You have intermediate goals. That's anything that takes from 1 to 5 years to complete. And then you have long-term goals. That's anything that takes 5 years or more to complete. You can have separate goals. You can say, I want to create a budget, or I want to save money, or I want to invest, or you can have separate goals, but it's also important to realize that your goals can complement each other. For example, if I have a long-term goal of buying a home, that's a 5 or more year goal. I might have an intermediate goal to save money for the down payment. That goal will complement my long-term goal, which is buying a home. And then I can have a short-term goal that complements that goal. That could be, I want to take a home buying class. I want to create a budget. I want to get started with my credit. These are goals that complement the overall long-term goal. So you can have standalone goals, but you can also have complementary goals. So it's important to make sure that you're sitting down and you're planning your finances amongst yourself. So we're going to hop right into credit. So we're going to talk a little bit about what's in a credit report. So inside of your credit report, it's identifying information. It's your personal information. It's your name. It's your address. If you've ever applied for a loan and said, I worked here, it's your job. It's your social security number, your date of birth. It's any car note that has reported to your credit report, personal loan, credit cards, student loans. There's medical bills if you haven't paid those. It has a lot of your information on this credit report. Now, what your credit report is basically, it's a piece of paper, and what lenders use this paper for is to determine what kind of a borrower you are. They want to determine if they're going to allow you to spend their money or to borrow their money. So most underwriters, when they look at your credit report, they don't really get to meet you. They create a story about who they believe that you are based on what's on this paper, and then they decide would they lend to that person. So it's really important that we fill our credit report with good things. There are creditors, payment history, any bankruptcies if you've had those, any inquiries, any place that you've been to and said, hey, pull my credit, I'm good for it. It's going to show up on your credit report. Who looks at your credit report and why do they look at your credit report? As I stated before, lenders look at your credit report. They want to know if you pay other people back before they give you their money. They want to know what kind of person you are before they allow you to borrow their funds. Landlords, they look at your credit report because they want to know what kind of person you are and if you're a reliable payer before they allow you to live in their property. Potential employers will pull your credit report. I know that when I worked at the IRS, they pulled my credit report because they wanted to be sure that I didn't have high pressure debt that would encourage me to have other or less than desirable activities at the workplace. Let's just say it that way. I also know that they pulled my credit report when I started at the credit union. A lot of part of that is they said they want me to practice what I preach. But also they wanted to make sure that I also did not have high pressing issues that would encourage me to have less than desirable behavior at work. So with that, insurance company will pull a copy of your credit report. They pull your credit report because they also want to know what kind of payment history you have, how reliable you are, other information that's on your credit report that goes into your payment, how much they're going to charge you for your insurance. Now, because insurance is required by law, when they do the soft pull of your credit report, they can receive information from your credit report, but it does not show up on your credit report as a hard inquiry. So yes, please shop around for insurance. And then financial institutions, when you go in to open up a bank account or get a loan from the bank, they will pull a copy of your credit report as well. So your credit score. I want you to always remember that your credit report is one thing and your credit score is another. Yes, they come together, they mingle, they work well together, but your credit report is what gets you approved or denied. The information that's on there gives you the yay or the nay. Your credit score gives you your interest if they say yes. So if they approve you of a loan based on your credit report information, they're going to give you a certain interest rate based on the score. So think of your score as like your financial GPA, right? So we go to school and all the way up, how well we do in each of our classes contributes to what GPA we're going to come out with. Your credit is the same way. How well we do with our finances is going to contribute to what we come out with on that score. So the better I do, the higher the score. FICO scores have a minimum of 300. Right? They automatically give you 300 points. You don't have to do anything for the 300 points. They just give it to you. You can't have less than that, right? So they start us off on the right foot. It doesn't always stay there, but they start us off on the right foot with giving us that 300 points. The maximum is 850. I'm here to tell you, nobody needs 850. I've pulled tens of thousands of credit reports as a loan officer, as a credit specialist, not one 850, not one. I've seen an 841, but she was like 120 years old. Like she worked for that. I've seen 817s, 811s. I've seen pretty decent scores, but I also have been in lending, and I know that locally, most financial institutions will give you the same interest rate if you have a 740 and above. So I can have an 850 or a 740, and these two people will get the same interest rate. So I don't need that. That gives me wiggle room, right? It says that I don't have to be perfect. I can still get 110 points less than the max and get the same interest rate, right? So breathe, right? We can breathe. Well, for 100 points less than that 740, I can buy a house. This is literally telling you that you don't have to be perfect. You just have to have good behavior, and you have to be good enough for these things, right? So there's wiggle room. So we're going to go around and we're going to talk about what gives us that score. So we know that they give us 300. That means that from the 300 to the 850 max, that's 550 points that we have to get on our own. 550 points. Let's say that this pie chart represents that 550 points. And it's broken into 5 different size slices of that pie. The largest slice, the biggest percentage is 35%, and that's based on payment history. It's important. It's pretty much the reason credit reports were created. They want to know how well you pay before they give you their money. If you don't pay well, they're not going to give it to you. Think of it this way. Think of it as you have a sibling, and this sibling never, ever, ever, ever pays your parents back. But they need to borrow $200. And the $200 that you have, you might need it for a bill. How likely are you to loan that $200 to that sibling? Probably not likely, because there's a good chance that they won't pay you back either. Banks do the same thing, but let's face it, we might give that money to our family member because they're family. But one thing that we forget is that we're not family with the banks. They don't know us like that. So they probably will not give us the money if our record says that we don't pay well. So making sure that we make all of our promised payments on time is a really important part of your points. This section is worth about 193 points of that 550, 35% of that. So it's a lot of points to lose in this category. We want to make sure that we make as many payments on time. I'm going to let you guys in on a little secret here. If you have to make a late payment, because I do know that society doesn't always create the perfect situation where you can never in life miss an entire payment. I encourage you to make your payments on time. But if you fall into that category where you cannot make a payment on time, at least make it before it's 30 days late. The reason being is they may charge you a late fee. They might send you threatening letters. They may start calling your references once you're late. They cannot tell anybody on your credit report that you have been late until you are 30 days late. Once that late payment goes onto your credit report, it stays on your credit report, and you're going to have to drown out that payment. So what that drowning out looks like is, say I have a loan, and this loan is a 10-month loan, and I make the first payment on time and the second payment late. 2 out of 10 payments I've made already, and my payment history is 50%. That means that I have made 1 on-time payment, 1 late payment. They can flip a quarter and determine the odds of my next payment. I don't know about you all, but I know that flipping a quarter is not going to work if you borrowed my money. So I need better odds than that. And what that looks like is the 8 remaining payments. If I make those on time, now I have 9 on-time payments, and I have 1 late payment. Now my odds are 90%. My payment history, instead of 50%, is 90%. Those are better odds. Like, I want them better if you borrow my money, but the bank will allow you to be at 90% and still borrow money. So just think about it that way. So if you have made a late payment and there's no coming back from that, try to drown that out with a bunch of on-time payments to make that late payment look really little, okay? So payment history, most important part of our credit report. Not the only important part, but very important. The second category, but by the way, before I go on to the second category, that first category, it is worth about 190 so points. So if I take that 100, if I make every single payment on time and enough on-time payments, I can take that 190 points and add it to the 300 that they've already given me before I go to the next category. So make this a game with yourself. Say, how many points can I get out of each and every category? And then pull points out, and that's how you build your score. So the second category is credit utilization. This category is basically how much of my credit am I using? And most of the time when you hear credit utilization, you're going to hear about credit cards, right? So with these credit cards, it's how much am I using of the balance that they've given me. A credit card is a card that they give you that has money available on there. You can use it, but you have to pay it back. You can use it again, but you have to pay it back. You can use it again, but you have to pay it back. So it's revolving. It doesn't go anywhere unless they close it out on you or you close it out on them, right? So it's like a forever loan. But there's rules to this loan when it comes to your credit. You don't ever want to be using 100% of what they've given you. For example, if they have given me a $300 limit, I never want to be using more than 90 of those dollars at a time. If they've given me a $1,000 limit, I never want to be using more than $300 at any given time. A good way to remember your credit utilization is that it's worth 30% of your score, so about 165 points, and it's also 30% or less for my utilization means healthy. It means stable. It means that I am not using every dime that they've given me. If I am maxed out on my credit cards, if they have given me $1,000 and I'm using $1,000, they're going to say, don't give her any more money. She's not paying any of this down. If you give her more money, she's going to spend that and we're going to lose more money. So in order to look responsible, you have to make sure you keep your balances low. So yeah, they want you to use it, but they don't really want you to use it. Like the credit card companies want you to use it, but the credit people on your credit report, they don't really want you to use it. It's not how it works, right? But if it made sense, we would all get it. So make sure that you are keeping those balances low. I also want you to know with credit cards, people are not freezing their cards in blocks of ice to prevent them from using them for no reason, right? It's easy to swipe when you don't have to pay the consequences right ahead of time. And before you had that credit card, when an emergency came up, you figured it out. You lived, you made it through without it. But when we get a credit card, everything seems like an emergency, right? No lie, I had this one client and I said, hey, we're going over your budget. You got to stop eating food on this credit card. This is the first time I've ever had one of my clients roll their neck at me. She says, well, you said credit cards were for emergency purposes and food is an emergency. So there. I said, okay, excuse me. I said, but I want to let you know that most doctors and most scientists say you can go 3 minutes without air, 3 days without water, 3 weeks without food. So not all of this food was an emergency. So we kind of went back and forth on that. And it wasn't until I said, hey, we were sitting down going over her budget. And I said, hey, I'm looking at your statements and I see that you're still paying interest on these Happy Meals that you got a couple of months ago. She no longer ate on that credit card because it's not an emergency and she's still paying for Happy Meals that have long left her system. Sometimes it takes different things from different people to realize when we should stop. That was her breaking point. So I want you to know that credit cards are a gimmick. They really don't get paid unless you roll over a balance. So their job is to get you to roll over a balance. Credit cards were typically for emergency purposes. So what that means is that I got a credit card just in case something happens. So if I get a flat tire and I've already spent my paycheck, I'm just going to put it on the credit card. And when I get paid, I'm going to pay it off. Or I'm going out of town and I want to make sure I don't get stranded, I'll take a credit card with me. Or going out of the country because they run on different regulations, I want to make sure that I'm okay. So these are reasons why you might or you should use your credit card. But with that, you want to make sure that you're still using it wisely. Emergencies don't happen every day for everybody, and credit card companies start realizing that. So what did they do? They said, hey, we need a marketing exec. We need these people to spend more money, make them buy things. The marketing exec said, I got it. Don't worry about it. I can fix this. Rewards. So now they're encouraging people to spend their credit cards for food, for gas, for groceries, for things that your typical paycheck should be covering. And what happens is that they put out these fancy commercials where they're not realistic, right? They have people fighting over the check at dinner because they're going to get points back. I've never fought over a check. I'll pay it. But once you say that you're going to pay it, you got it. I'm not going to fight over a check. It's not that serious, but they are to get points back. So they're like, we'll give them 5% back at the gas stations, 3% back on groceries and fast food. We'll give them 1% back on everything else. So now everybody's out swiping. And before you know it, you have swiped up about $2,000 worth of debt. But they don't require you to pay it all down. They want you to pay the minimum payment so that they can earn money and interest off of the remaining amount that you can't pay down. So what happens if you can't pay that down? They're going to say, you know what? You did a great job swiping that card. Here is your $17 in cash back rewards. But if I can't pay down this $2,000, they're going to be like, well, that's going to be $75 in interest this month. And if I can't pay it all the way down next month, they're going to be like, well, that's going to be another $70. And the month after that, maybe $65. And if I'm still struggling to pay down everything that I spent, $60 the following month. So I end up spending hundreds of dollars paying interest, but at least I got that $17 in cash back rewards. They don't print it out that way because if they did, who would do it? So just understand the gimmick with credit cards and know when you're being had. And credit cards aren't bad. It's nice to have a backup plan, an emergency plan, an escape route for certain things. But it's also wise to know when you should spend and when you should not spend and how quickly you should pay down something if you use it. So credit utilization, right? We want to use it, but we don't want to do too much. So your length of credit or your credit history, not all the time does credit make sense. So this is how long my credit is. Lenders and underwriters are going to look at my credit report and determine if I'm worthy of a loan. They're going to look at my credit report. They need it to say something. They need longevity. They want to see if I've paid off a car before, if I've paid off a personal loan or student loans, or they want to see enough information to help them make a decision. This is why people who don't have any credit at all are not always approved because they've done nothing wrong, right? But they've done nothing right either. So with this, they need history, and you can't get history if you're opening and closing accounts randomly. For example, if I go and I say, hey, I'm going to go into the bank, I need a loan, I need $600, and I'm going to pay this back over 12 months. The bank says, okay, we can do that. Here's what we're going to do. We're going to give you the $600. You're going to pay us $52 every month. $50 is going to go towards the amount that you owe us, and $2 is going to go towards the interest. If I have not stated already, interest is a fee that the banks or the lenders charge for giving you the loan today. That means that I'm going to give you the loan today, and you're going to pay me back later. But because you're paying me back later and not today, you're going to pay me a small fee along with the money that you owe me. That's interest. It works, right? It's a healthy relationship. You get the loan today, I get the money later with a little extra, right? Scratch your back, I'm going to scratch mine, you scratch yours. It's going to be good. So if I get the $600 loan and I have to pay them back $52 in interest every month, $50 on the amount I owe, $2 in interest. It's important to know that you can't owe interest until it's happened. That's important. You can't owe it until it's happened. So if I get this loan and I'm supposed to make this payments back over 12 months and I walk out of the bank and then I go 3 days later, I realize that I have a stimulus check. I'm going to pay the bank back. They're not going to have to search my references and call them. They're not going to have to worry if I'm going to pay or not. I'm going to pay them back right now. I'm feeling good, right? I only had their money for 3 days. I'm feeling really good. I paid them back. I did a great job, right? I mean, sort of. I gave them their money back. But what I didn't realize is that the bank pays for the building that you apply for the loan in. They pay for the lender's salary and the underwriter's salary to get your application together. They pay $7 for every credit pull. They pay for the teller to give you your money. They are willing to do all of this, and they do it all with the hopes of earning that $2 a month in interest. So if you have paid it off in 3 days, how much interest did you pay? Pennies, literally pennies. They made no money out of this deal. And when it comes to lending, it has to be a really good relationship. I never encourage anybody to stay in a loan longer than they have to, especially if there's a higher interest rate. But to get a loan and pay it off, and get another loan and pay that one off quickly, and get another one and pay it off the next month, and get another one and pay it off, your length of history or your credit age is going to be really low. Really, really low. So it's important to let those accounts fester on your credit report. Like, it's not going to help me in the long run in my household bills, but would you pay $2 every month to have somebody report good activity on your credit report? I probably would. As a matter of fact, there's a lot of products, credit builder products and credit builder loans that people go and get to pay themselves just to have something report on-time payment, because I need that on-time payment to get bigger items like a car, like a house, like that new condo I saw, like these things that I feel that I must have. Whatever your poison is, whatever it is, you need this to get to there. So it's not a big deal, but we want to make sure that we're not opening and closing things. As a lender, I'm not a lender right now, but as a lender, if I see that someone is opening loans and it's costing me to originate these and closing them in 3 days, and they're doing that repeatedly, I'm not going to want to do that deal. Good credit or not, I'm going to lose money in this deal. And you're going to have a lower credit age, which is going to affect your 15% of those points. So it's important to be wise with your credit. Know when to open, know when to close. Not only that, I kind of ganked myself because I could have had 12 on-time payments. And we know how important on-time payments are, right? 35% of the score, that important. So with that, sometimes common sense does not always make sense. And a lot of what I do is preach that healthy relationship between the consumer and the lender. So one time I had this one guy come into my office when I was a loan officer. He was from a country in Africa. I don't remember exactly which country it was. And he's smiling, and I'm like, why are you so happy today? What's going on? And he says, America's the greatest country in the world. Now, honestly, I started thinking, I'm like, you know what, just wait a minute here. You know, Finland got the smallest gap between rich and poor. Australia's in no treaties, no wars. A lot of people here are getting dual citizenships in Canada and dual citizenships in Switzerland. I mean, I think some other people are getting it right too. He said, well, when you explain it that way, I see. But in my experience with my country, he said, they don't take IOUs. They don't take winks, handshakes, get you laters, signatures, none of that. In his country, if you didn't have all of the money for a car, you didn't get a car. If you didn't have all of the money for a house, you stayed in a village. There were no food stamps, EBT, SNAP programs that swooped in and fed your children when they were hungry. They ate what you can afford to provide. So he's here on a work visa, and he's making a lot of money, and he's sending money back home. He has enough money here. And he's amazed at the system. He comes in, and God forbid anybody starves in the state of Missouri, he has expedited EBT or SNAP or whatever they're calling it these days. He got it expedited. He started working. He's able to send money back. There's residential housing for him. Things great. He went to work today, and somebody told him that if he came into the credit union, he can get a car without bringing any money. And he came in, and he was smiling because he wanted to know if it was true or if they were pulling his leg, because it's not anything that he was used to. And what that kind of reminded me is that we have a cash or credit system here in the United States. If you don't have the credit, you have to have the cash. If you don't have the cash, you need to have the credit. You can still get all of the things that you feel you need or you want, but you have to have one other. You can't have neither. So it's really important, but it also works out that balance, that relationship between consumer and lender, where we're expecting lenders not to take advantage of you, but we're also expecting consumers to pay back if they say they're going to pay back. Make sure that whenever you have a relationship with the lender, it's healthy. Make sure that you feel that your deal or the amount that you're paying is a decent amount. Make sure that you feel comfortable in that deal before signing any contracts. 10% and 10%. The final two 10% go to two smaller categories. Still important, but smaller. One of them is a credit mix. They want to know how well you're doing with all of your credit, right? Your revolving, that will be your credit card where you can pay and use it and pay and use it. Your installment, that's anything that has a balance where once you're done paying it off, you're done. That's the student loans, your car loan, your personal loan, a mortgage. You want to know how well you're doing with your secured debt and your unsecured debt, right? So how well you're doing with debt that has collateral, that's secured with collateral. That would be my car note. If I don't pay my car note, they get to take my car. That would be my mortgage. If I don't pay my mortgage, they get to take my house. They want to know how well I'm doing with those items. They also want to know how well I'm doing with the items that don't have any collateral attached to them, like a personal loan. If I don't pay my personal loan, what they're going to do about it, right? There's no collateral. No, please pay your personal loans. But there's nothing attached to them. And for that reason, people tend to pay those less than they pay the secured. Like, I'm going to pay my car note because if I don't, they're going to come pick it up, right? But if I don't pay this personal loan, they're going to have to wait till I do. Or take me to court, which is a hefty process, and it's an expensive one. So more than likely, they know that people pay one type over the other for obvious reasons. So that 10% of credit mix, they want to know how well I'm doing with all of my credit, not just a part of it. And then the credit inquiries is 10%, right? This is anytime you use your credit to say I'm good for it. If you walk into the bank and say I want a personal loan, that's going to be a hit. If you walk into Macy's and say, hey girl, save 15%, apply for a credit card today, that's going to be a hint. By the way, I'm completely against store cards because it's never going to be an emergency to go inside of Macy's. Nonetheless, make sure that whatever cards you get makes sense to you, but I would like a universal one because I also can't go into the dealership when I need car repairs and wave around a Macy's card. That's not going to work. So making sure that you have universal cards that may bend to your needs is very important, but also being very picky and very choosy with who you allow to pull a copy of your credit report. So for me, not everybody's going to get a chance to pull my credit report. Like, to buy a car, yes, because I'm not going to walk. To buy a house, yes, because I need that. But like to walk inside of Old Navy, nah. For any of those smaller things, no, just wait, make sure that you are planning for people to pull your credit report and that you're not randomly allowing people to pull it, because every time they do, your credit report takes a hit, right? It's backwards. I'm building up my credit for somebody to see it, but then as soon as they see it, it's going to go down, right? So making sure that we are not taking any unnecessary hits that we don't need to take, and we are picky and choosy about who we allow to pull our credit report. Honestly, if you do well in each of these categories, you can have really good credit, right? You go around to each of these slices of the pie and you pull out as many points as you can to add to the 300 that they've given you, and that's what gives you your score, right? So what does that look like? This is how you compare yourself based on what area you're in or what category you're in. If you're 800 to 850, which not a lot of people are in, enough people, but not the majority, you have exceptional credit. There's probably nothing people won't give you. as long as you have the money to pay it back. Like, yeah, I can have excellent credit, but if I have a job, they're not going to give it to me. That does not make sense. Okay, but I can just about get whatever I want because I have done everything right on my credit report, and my score is going to tell that story. Very good credit, 740 to 799. That's still pretty decent credit. I can still get the lowest interest rate that most financial institutions offer. That 640 to 739, I can still buy an entire house with just good credit. I don't even have to be perfect. I can just have good credit and still buy a house. So that shows where you match up. If you've pulled your credit recently and it shows that you're at 580, or it shows that you're in the poor 300 to 579 category, then go through your actual report and say, what have I done that does not align with what she said tonight? And see what it is that you can do to fix those problems, and then your score will go back up. It's that simple, right? So what does it cost me? This is a chart that I put together. It's called a consumer rate sheet, and most lenders use something similar to this. This is how they determine how much they're going to charge you for an item in interest after they've approved you. So I have to tell you yes first, right? But do you remember at the beginning of this presentation when I said that your credit report gives you the yes or the no, and your interest rate itself is decided based on your score? So if you look in this first category, let's say we want a car, okay? And we want something reliable, we want something hot for whatever reason. We're going to get a 2020 or 2023 car. We want it new. Okay, that's fine. If I have A plus credit, remember that's 740 and above for that lowest interest. I can get an interest rate of 3.79% with that, right? That's decent for a loan with collateral. Let's say my credit is less than favorable. I would have to scroll all the way down to that last category, that's 570 and below, and the interest rate there is 16.99%. Now, you're probably saying, 16 is not that far from 3. 100 is farther from 100. It's still pretty decent. I'll take that. I'll allow it. But how much does it really cost? How much does having poor credit cost? How much does having low credit cost? So if I have the decent score of 740 and above and I have that 3.79%, it's going to be a lot different, and it's going to cost me a lot less than that 16.99. How much? I'm going to tell you how much. So let's say I have a car in mind, and it's $15,000. And I'm going to do the average 5 years. That's typically how long people finance cars. 5 years. That's 60 months. And I'm going to do it at that 3.79% interest rate. That means that my car payment is going to be $275 every single month. By the time I'm done paying this loan, I would have paid back the $15,000 that I borrowed, plus $1,490 in interest. Remember, that's the fee. That is how much I'm paying for getting the car today without having all the money for the car today, right? $1,400 seemed like a lot, but honestly, over 5 years, it's decent. Okay, but what if I wanted that same exact car for $15,000 for the same exact 60 months or 5 years, but I had that poorer credit, that 570 and below, and they gave me the interest rate of 16.99%. That's going to cost me $373 every single month. Now, I don't know about anybody else, but I would love to have an extra $100 back in my pocket every month. But what does it actually cost me? Because the $373, it still feels doable. I still feel like I can pay that $373, right? But for the same exact car, solely because my score is lower, I'm going to pay back the $15,000 that I borrowed for the car. But instead of paying $1,490, so basically like $1,500 in interest, I'm going to pay $7,400 in interest. An extra $6,000. That is what 100 extra dollars every month for 5 years or 60 months is. It's $6,000. Who wants to pay $6,000 for the same exact car solely because their score is lower? Right? That is how much 16.99% interest is going to cost you. So with that, I never judge people, and I never tell people don't get that car because you have bad credit, because I'm not going to give you rides. I can't tell you that not get something that you need, like I'm going to back you up and take you to work and help you with everything else that you're doing. So I don't tell people what to do. But I tell people, if you find yourself in a position where you have to get a car at a higher interest rate because you absolutely need transportation, then after you get that car, you need to work to build your credit up and do a refinance so you can come out of that high interest rate. So if you get it and you acknowledge the fact that this is higher than it should be, but I really need this car, it's okay. It is okay, because I'm not going to walk either. But make sure that you are working diligently to reduce the amount that you're paying for that car in the long run. Because I can get this car and it can cost me $373 today, and in 3 months I build up my credit and I do a refinance, and I can be at the $275 for the remaining 57 months, which is going to save me that $6,000 in interest. So keep that in mind if you ever find yourself in that long-term loan. So the ideal candidate, if I want to lend money to somebody, what do I want them to look like, right? Not physically, but on the credit report, remember, because I don't get to see you. If I'm making a decision about your loan, I don't get to meet you. It's not like you see in the movies where they walk up to the desk and they say, I need a loan, and the guy at the desk says yay or nay. That's not the case. It goes off in a file to the person that does make that decision. So what they're going to want you to have is 3 trade lines. Trade lines are things that you make on-time payments to every month. That can be a car loan, a personal loan, credit card, a CD loan, just a student loan. 3 records to show that you can make on-time payments. That's enough for me. Like, the more, the better. But at 3, I feel like I can get a pretty good picture of your payment history. And I would like there to be no late payments. I mean, because honestly, I'm giving my money to a complete stranger. I want to see that they give it back. Not having my money back is worst case scenario. So I don't want anything that's going to make me feel like you're not going to give me my money back. Just being honest. No collections. Collections are late payments, but they're so late that they had to go to a special section on your credit report. That's too late, okay? So we want to make sure that we don't collect any collections on our credit report, or that we take care of our bills ahead of time. And if you find yourself with a bill that you cannot pay, work out something with the company so that they don't put it on your credit report. That's favorable. No judgments or public records. There is a point that I can get to where I feel like I've had too much debt. I've had too much debt, and I got to go to the courts and beg for mercy. And they might put me in a bankruptcy, and this bankruptcy might allow me to clear my debt. But now I have this stain on my credit report for 10 years, telling everybody that I got in so much trouble and that I had to be bailed out by the government. And people don't like that. It's kind of frowned upon when you look at your credit report. They do start forgiving you as time goes on if you're behaving better than you were before. They kind of give you that leeway. But that's what a public record is, and it does hold down points in your credit report. So then you have low credit card utilization. If you come and ask me for money, I need to feel like you're not desperate. I need to feel like you're not maxed out on your credit card. These are what lenders are looking for. So if you want to apply for something, say, okay, well, how do I line up to these things that they're looking for? I don't have any collections, check. I have very few late payments. That's fine. I have multiple trade lines for them to make a decision, check. I don't have any public records because I haven't made it to that point where I can't pay any of my creditors back, check. My credit card balance that I have is really low, check, and I have activity for 6 months. That gives them at least something to go back and look at to figure out who I am or what I look like. They don't get to see you. They get to make a fake facade of who they think you are based on the information presented, and then they decide if they're going to lend to the person that they've envisioned that you are. So we want to make sure that our credit report is showing really good items, a good mixture of our credit, as we said that 10% before. So what if I have no credit, right? Having no credit is just like having bad credit, right? I said it. It is, because I don't know what you're going to do. I might have Pam come into the bank, and Pam might say, listen, I know I've made late payments on my car note in the past. I get behind every year at Christmas time because it's Christmas time, but by income tax time, I'm all caught up every year. Pam is going to have bad credit because Pam got a lot of late payments, right? But there's history there. I feel like I'm not going to lose all of my money with Pam. I don't feel like Pam is going to jump the border and take off and never pay me again. But if I look at your credit report and there's nothing there, it's like a wild card. I have no idea what you're going to do. I don't know if I want to give you my money. That's kind of how they look at you, like you've done something wrong before. So what is the cost? Well, denials. Everybody's going to be like, no, don't give them that money. Everybody does that. They're going to be like, I don't know if I want them to stay in my house, the landlords, because I don't know what they're going to do. Lenders, I don't know about that because we're not in the business of taking any losses. Everybody starts turning their nose up at you because you have done nothing yet, right? So how do I fix that? Well, you can start with a secured card. A secured card is a credit card, but instead of them just giving you money freely, they're going to say, you got to put your money up first. You got to prove yourself. So that means that I'm going to go in, I'm going to say, here's $300. If you give me a $300 credit card, I promise I'm going to pay it back. If I don't pay it back, you get to keep my $300. Eventually, you'll get your $300 back. But you have to prove yourself. And as you get that secured card and you're making those payments back on time, you're making yourself look more reliable and you're building up history so that you have something on your credit report to kind of give them an idea of who you are. Well, I know she has a secured credit card and she's been making the payments back on time for 6 months. I'm okay with giving her a loan. At least I know that she knows how to make payments, right? So you start small and you build that up. A lot of banks have city loans where you make payments into your savings and they count it as an on-time payment and they report it to the credit bureau. A lot of places have CD loans where you can do a loan against your own money that you put in a CD, certificate of deposit is what it's called. Self-Lender has some products. Experian Boost has some products. The most popular one, if you are, well, you can be any age, but typically younger is best for this case scenario, is an authorized user. An authorized user means that you get to go on somebody else's card and have no consequences, right? But every time they get an on-time payment, you get an on-time payment. So most people do this with their children. My son, he is 11. But once he turns 13, he gets to go on my account as an authorized user. What that looks like for him is that every time I make an on-time payment, on his credit report, he will have an on-time payment. Now, he's never going to be responsible for any of the balance because he's an authorized user. I'm the person that owns the account. It's my responsibility. So he's never going to pay for that. But I have to be careful because if I make a late payment, he's going to get a late payment. So sometimes being an authorized user can backfire. But if I make every single payment on time by the time that he becomes 18, he's going to have 5 years of on-time payments, and he's not even going to need me to co-sign for him because he's going to start off with decent credit. So you can become an authorized user. But before you ask your parents if you can become an authorized user on their account, make sure they pay on time. Okay, that's really important. But if they add you, they can give you the card or they can decide not to give you the card. Either way, you can still get those on-time payments on there and you won't need a co-signer and you won't have everybody tuning their nose up at you because you have no credit. You can establish some this way. Once you have that credit card history on your credit report, then you can go back and apply for your own credit card and then you won't need that and you can come off of that if you would like. So a lot of times people say, Credit Karma isn't accurate. That's not right. That's different. Well, it is different, but they're pulling your information from the same exact place. So they do get the information from the credit bureaus. And it's not that they're not accurate. They're just giving you a different module. So most lenders, I believe about 97% of lenders pull FICO. They pull FICO. FICO has the best information that allow lenders to make the best decision before they give a loan out. It gives them extra information. What Credit Karma gives you is called Vantage. So instead of FICO, it's called Vantage. So Credit Karma, Credit Wise, Credit Journey, Credit Sesame, they all give you different credit bureaus, but they give you Vantage. So why did they give me a different score? Vantage has a different formula. And it is used by some lenders, but it's outdated. And everybody's pulling FICO. FICO's fancier. FICO gives more information. FICO's more expensive for lenders to have. But with that, the scores are similar because they are using the same categories. They are just differently weighted. The formula is weighted. So for FICO, we know our payment history is 35% of our score. That's a lot of points. But for Vantage, it's 40%. So like, oh crap, I can earn or lose more points with my payment history on Vantage, right? If you go to a lender and that lender is not pulling Vantage, they are not going to see the score that you see in Credit Karma. If they are pulling FICO, they will see your FICO score. If they're pulling Vantage, they'll see the same score that you see in there. So it's important to keep in mind that they are similar. The scores will be similar because the categories are similar, but these are two different reports, and it does not mean that one is a fake score. It means that it's a different score. So if you have not already done so, you can always reach out to annualcreditreport.com and get a copy of each of your credit reports from the three main bureaus, TransUnion, Equifax, and Experian, for free. They're not going to give you a score. They're going to charge you and say, hey, sign up for this free trial, and we'll give you your score, but cancel it before the 7 days is up if you are not planning on continuing that partnership with them. Just a forewarning. But they will give you a credit report and you can see exactly what is on there, and you can do this every single year. Some people get all of their credit reports on one day and they compare them. Some people get one credit report every 3 or 4 months so that they can spread them out throughout the year and kind of keep an eye on it. But there's other methods that you can use now to monitor your credit, but you are entitled to one. And make sure that you do understand that it's annualcreditreport.com, not free credit report, not free annual, not any of that, annualcreditreport.com. So there are some resources. You can go to annualcreditreport.com. You can go directly to the credit bureau for resources about your credit report. You can call them. They will answer. You can ask them whatever questions you want to ask them about your credit report. You also can follow FTC, that's the Federal Trade Commission. They give you information about your credit and other resources there. And Prosperity Connection is an organization where you can go. It's 100% free. They are not allowed to charge you anything, but you can go to Prosperity Connection. They can do a soft pull of your FICO score. They can help you complete disputes if you need that. They can help walk you through certain process, recommend products that work best for your score, help you monitor that. Whatever it is that you're needing with your credit, they can do it, and they'll do it 100% free, okay? Because financial literacy and financial education should not cost. So they will be able to help you with that. They will set you up with a coach, and this is your go-to person. This person will set up appointments with you, meet with you as frequent as you would like, or as less frequent as you would like, on your own terms. And you work through that situation that way so you can kind of build your financial stability. If your report has any errors, they can help you do the disputes, or you can do the disputes yourself. You can write a dispute letter simply saying, this is not mine, please have them prove it. And you can send it to the 3 bureaus. You can send it to the issuing company. If something on there is not yours, you can keep a copy for yourself. Make sure you keep all your original documents. And if it's something that's common and you notice that a lot of people are seeing the same thing, you can send it to the state attorney general and have them open up an investigation. So depending on what kind of dispute you're needing, you can do that. But I also want you to be wary of the pitfalls. Be wary of the predatory pitfalls. A lot of times I might have multiple loan records, and it seems like it'll be much easier to consolidate those and have just one that I'm paying. But I might consolidate those into a much higher interest rate and end up paying a lot more than I would have. Be wary of payday lenders and rent-to-own and pawn shops and title loan companies. So for that, I'm actually going to go just into a little bit of detail for each of these. Predatory lending refers to any unethical practice used to conduct lending between a consumer and a business. So with that, it's unethical. Unethical basically means unfair or deceptive, or they're tricking me. I like to call it legalized loan sharking. And every time I think about predatory lending, I think of like this guy with this top hat in the shadowy area with a toothpick in his mouth, flipping a quarter. Like it's very shady. It feels uncomfortable. Predatory loans, it's important to know that they have an average interest rate of about 391. That's as of this year in Missouri. It's important to know that there's no cap. They can charge you 800% interest rates. There is not a cap in a lot of states. Some states cap it. A lot of states do not cap how much somebody can charge you in interest. And you probably say, okay, what is that? What does that mean? Remember when we were talking about the auto loan and I said 3.79% was really good for an auto loan, and I said 16.99% cost us that extra $6,000? Well, if we were turning our nose up at that 16.99%, try 400%. 400%. Who would like to walk? And that's an average. That means some people pay more and less. Who would like to walk into a place and say and borrow $1,000 and end up paying back $5,000? If you walked in and they said, yeah, I'll give you the $1,000 that you need, but you're going to have to pay me back $5,000 in the long run, how many people would still sign up to do it? Not many, right? But they don't say it that way. They say, here's your interest rate. It's 391%. You're going to make these payments back every month. It's going to be fine. And then it's not fine. So with that, making sure that you understand what a decent interest rate looks like and how much the cost of business is going to do. A lot of times they put these payday lending or predatory lending practices into low to moderate income areas. Why do they do that, right? Why do they put it there? You know them people are struggling enough and they're working their way out of a lot of situations that society has created. Why would you put them there? Well, how much business do you think a payday loan company would get in a high income area? They're not going to get any business. It only makes sense for them to put them in other areas, in low to moderate income areas where they know that people are working, they have jobs, but they need a little bit more because they might not be paying enough. So they put them in those areas because that's where people are going to use them. It's important to know that a lot of personal finance experts cite any percentage above 30% as non-affordable or predatory. So with that, what is a payday loan? So payday lending is basically what it sounds like. It's a loan until my payday comes. I might be a little bit short on cash and I go to this company and I say, hey, I need more money than I have now. And they say, okay, well, we'll give you more money, but we're going to charge you interest. It's important to know that this interest can go all the way up to 800%. It can go up higher than that. They can charge me whatever interest they believe that I'm worthy of paying, and that interest can still be high whether I have good credit or not, right? Solely because I need the money right now, I need it today, and they're going to give it to me. So with that, it's a small amount, but what I have to do is I have to post date a check to them. Out of my next check, I have to pay them that, plus fees, plus interest. Now, if I don't have it, which I might not have it, because if I didn't have money this past pay period, I'm not going to have money to pay all of the same bills this month plus this additional bill. So there's a good chance that I might not have it. When I come back in and I say, listen, you're going to take it, but I need another loan. This is how you in-house refinance your payday loan. People do that and they keep cycling it out. So now I couldn't pay you the $600 from the $300 I borrowed. I have to come back in and they're going to take the $600, but now I need another loan. I need more money. So they're going to say, okay, well, we can take it, but we can give it back and you'll have to pay us again. And I'm in this cycle where I'm steady doing the same thing over and over again because I can't go without the $600. And they're making that much money out of me each time I go in, and it's just a never-ending cycle. I'm never going to get ahead, right? So with that, I broke it. So with that, it's important to know that this is what costs. This is the cost of doing business. So with predatory lending, they typically have higher interest rates. So we want to go to the next slide, and we want to talk about title loans. Now, title loans are the same, right? Title loans are virtually the same thing. It's a loan with a high interest rate. It's a predatory loan. But here's the catch on this. You got to put your car up. I can have a $15,000 car, right? And I go in and I say, listen, I need a loan. I need a quick loan. And they're going to say, yeah, we'll give you a loan, but you're going to have to give us your title. And if you don't come back and pay us, we're going to keep the car. It doesn't matter if I only borrowed $500 and I got a $15,000 car. They can keep the entire car if I don't pay back the $500 plus the high interest rate, which means I might owe $1,000 plus the fees, which means I might owe $1,500. And if I don't have the $1,500, they just got a new car. That is the price of putting your car up. So I never recommend that you put your car up. Please put your firstborn child up before you put your car up. I kid, but think about those things. Think about the possibility of losing the items that you're putting up before you do so. And then think about the interest rate. Is it predatory? Can I afford this? Am I going to see my way out in the long run? There's other variations of predatory lending, right? How many people have heard of 90 days same as cash? Most of the time, this is like on furniture. They say, hey, come on in. Look around. Anything that you want? And you say, yeah, because I'm really wanting this couch. I just got a new place. I want this couch. I want to go ahead and pay for it. Now, the couch flat out is $500. But if you don't have the $500 to get the couch, we can set you up on a payment plan. So they set you up on a payment plan that has the high interest rate included and everything else like that. They say what you'll do is you'll pay about $50 every 2 weeks for this couch, and, it'll be done when it's done. And you say, I can do that. They say, but listen, hear me out. If you pay it off in 90 days, no interest, no fees. You say, 90 days? I can come up with $500 in 90 days. I can do, right? But you come in to make your first payment, and because you're still on the payment plan, you can pay more, but you can't pay less. So you come in and they say, you say, here, I want to make $200 payment. They say, well, you only got 50 due today. You ain't got to pay the whole thing. You got something else you want to go buy? Just put 50 on it and think about it. Think it over. And you're like, yeah, that sounds real good to put $50 on it and take $150 extra that I didn't think I was going to have. I just pay them extra next time. And I go out and I buy these new shoes because they was cute. And then I come back in for my next payment. And they say, oh, well, you only got that $50. And it's starting to sound real good to me, right? Because if I had to put my couch on a payment plan, I probably don't got all the money to pay up front. So I do that. Before I know it, boom, there's 90 days. I ain't got the other money to give them for this couch. I don't have the full amount to give them for the couch. So with that, they're going to say, if you can't pay it back today, we're going to have to go all the way back to the beginning of the 90 days and back charge you interest, okay? And the interest accumulates on there because now you're in the loan. Remember, they set you up for the loan. If you were to pay it off in 90 days, they was going to scratch it off for you. But because you couldn't make it, now you have 90 days of interest added onto your loan automatically. And now you also have future interest and future things to pay on. So it's important to remember that if you cannot pay it off in 90 days, do not get it 90 days, same as cash. Rental is similar. Who wants to pay $1,800 for a $400 washer? Really? Not at all. I don't want to pay $23 for the next 10 years of my life. They're not even going to be selling this washer by the time I pay it off. Think about how much interest and how much you're going to be paying. The payments are low. They last forever, and you end up paying way more. Instead of just saving and them flat out, now you are coming up with a payment plan and high interest, right? And they can charge you the same interest that we talked about with the payday lending. And then pawn shops, where you get to the point where I need money and I need it quick, so I'm going to take my item into the pawn shop. They're going to give me little to nothing for it, but it's going to come with fees and it's going to come with interest. If I do not come back in and I miss one single payment by one single day, they can keep my entire item. It doesn't matter how much it's worth. So if I go in and I put in a PlayStation 20, and they say, you know, this is worth about $5 billion, but we'll give you $200 for it. And they give me the $200 for it, and I don't come back in and pay the $390 that I owe them. They can keep my $1 billion PlayStation 20. So with that, I have to make sure that I'm signing up for things and I understand how much it's going to cost, right? And with the rent-to-own, I have to make sure that there's no early prepayment penalty. A lot of times they don't want you to pay early because if you pay early, that's less interest. Remember, I said you cannot pay interest until it's occurred, until it's happened. So with that, make sure that you understand your contracts completely. You understand what a good interest rate is. And then we've all heard of those buy her, pay her places, right? No credit down, no money down. You don't even have to be working full time. Just make some money. We'll give you a car, right? We hear them a lot, and it sounds good, especially if we're on the other end of things. If we're not doing so well, these things sound amazing. I feel like they're talking directly to me if I'm in this situation, right? So you go in, and typically what these car shops do is they're buy her, they're pay her. That means you just come back and you pay me every single month for the vehicle. But typically what they do is they're running a game. They're giving you used cars. These cars are on their last legs. I mean, like everything is, you might lift up the hood and see the engine drawn on a piece of paper. Like they are about to go out at any second, but you don't know that because they got all kind of coat hangers in there holding up the engine and it's running, it's on. When you come in, the outside looks nice. So you get this loan and then it breaks down the street. I knew this car was a piece of crap. I knew that I should have test drove it. I knew I should have did this, that, and other. So you come back and you say, you sold me this car. This car is junk. I don't want this. And they say, ooh, but you signed a contract. So the car is yours, and we'll see you when the payment's due. And you say, well, everything's falling apart. It's going to cost this amount and this amount. And they're going to say, well, I'll start off by telling you need to get the fuel pump done. That's going to cost you at least $600. Aside from that, you might have to get the timing chain done. That's going to cost you a little money. But go ahead and do that. What these companies do is they charge you a disproportionate amount ahead of time as a down payment. They know that these cars aren't worth much. They know that you're going to have problems. They know that there's a chance that you might stop paying. We want our money up front. This car is $8,000, but I need like $2,500 before you can drive off the lot. So I've already gotten a bulk of your money. You've driven off and it's falling apart. Everything is falling apart. You're carrying the bumper. You come back in and you say, everything's falling apart. This is not right. He's like, ooh, but I got a contract. So you go out and you're trying to get these things fixed on the car. Every time you get something fixed, something else breaks. You get something else fixed, something else breaks. And finally, you have had it. You are done. My payments is high. The interest is high. The car is falling apart. It's not worth it. So you drive the car back to the shop on its last leg and you drop it off and you say, I'm done. I don't want it. I don't care what you do. This is not working. Well, you think you've done a good job by giving the car back and forcing them to take it, but typically what they do is they're going to take the car back from you, they're going to rig it up and sell it to somebody else. But on your credit report, it's going to show that you have a voluntary repossession, and it's going to show that you still owe what you had. And unless they sell it to somebody else for another amount, that you're responsible for it, whether you dropped it off, whether you have the car or not. So he's going to fix that car up, and he's going to go to the next person and say, hey, $5,000 if you want this car, and they're going to buy the car. Now, that $5,000 is technically supposed to come off the balance that you owe because they can't charge two people for the same car for the same amount. So if they buy for $5,000, that debt transfers off of yours, and you owe whatever is remaining. That includes late fees, high interest, past penalties, everything. And it goes on to that, and that person is going to realize that you didn't fix enough, and other things are falling apart, and the cycle repeats. So before you go to a buy her, pay her, just understand that a lot of times these cars are not reliable, and if you think that you can't afford another car, another reliable car, a few extra dollars to go to a different type of dealership, think about how much you can't afford to be fixing everything under the hood once you get these cars. So be weary. I'm not saying that every used car, buy her, pay her, is bad, but I am saying there's a trend. There's a pattern. So be mindful of those things when you go. So if they're offering cars to people with poor credit or no credit, past bankruptcies, you live in a box, we're okay with that. You only make $200 a month, we can slide, we can work something out. Those cars, they're too desperate to get you in there. And if it feels too good to be true, it usually is. So avoid any predatory lending if you can. You can do this by going to your bank and seeing what they have available. You can go to your bank and say, hey, I want a car loan. Can you help me out? See what they say first, because they might be willing to help you out. Your bank has to like you. Your money goes there. You're friends. You know each other. They have to give you a little bit more leniency than other people actually give you. Any interest rate in the 3 digits is absolutely not. Now, I don't tell people what they can and can't do, but I'm going to tell you that you should not do that. That is entirely too high. We saw how much 16% cost us. 100, 101, 102, 800, too much, right? Never sign a contract that you do not know and that you have not seen. So I seen this experiment where they gave out contracts to the class, and the contracts basically, they was like, oh, that just means that you can't use any of this stuff outside of here. And everybody signed the contract and gave it in. But what the contract said was that you have to voluntarily give them $500 a month for the rest of your life or your firstborn kid. Obviously, they didn't want the $500 a month or the firstborn kid. The actual study was to show you how often people don't read contracts. There was not anybody in the classroom that did not sign the contract. So it's important to make sure that you are reading so you understand exactly what they are saying and how much things are going to cost you. Before you sign any contracts, you can avoid a lot of stuff, because if you're going through the contract and it says firstborn child, you're going to be like, wait a minute. So make sure that you are reading those contracts and you do agree to the terms before you sign it. And then also make sure that you understand the signs of predatory lender and know when you've been had. If you find yourself in a position where you have utilized a predatory lender, try to go to your bank and see if they have any products to get you out of payday loans. Sometimes the banks are giving granted money to offer you a smaller loan with a lower interest rate to get you out of the payday loans or the predatory lending. Also, make sure that you can try to apply for another loan with a lower interest rate to get you out of the high interest rate loan. That is refinancing that loan with a different person. So those are some ways that you can escape. Done. I want to thank everybody for taking the opportunity to watch this or to listen. If you have any questions, make sure you let us know, and have a great night.